Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing HIMS and HERS stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. HIMS and HERS is a telehealth company that sells prescription and over-the-counter drugs online as well as personal care products. It is best known for selling generic treatments for erectile dysfunction and hair loss. The company offers online consultations in order to get a prescription. The platform connects clients to doctors who prescribe the drugs based on an online intake form and photographs. Some experts have expressed concerns about the safety of this process. Since 2018, it has run advertisement campaigns on TV, social networks, subway stations, and sports stadiums. Facebook removed 3 ads for violating its policies on prescription drugs. The company initially sold erectile dysfunction treatment, sildenafil, and hair loss treatments such as minoxidil and DHT-blocking shampoo. In late 2018, HIMS launched HERS, a brand targeted to women, selling birth control pills. In 2019, it launched in the UK. In 2020, it launched mental health services, including anonymous group therapy. In October 2020, HIMS closed a deal with Oaktree Capital Management to go public via a SPAC, a special purpose acquisition company. As part of the deal, the company was renamed from HIMS to HIMS and HERS Health. It started trading publicly in January of this year. It currently has 294 U.S. licensed healthcare providers. In 2018, the company had 431,000 telehealth consultations. That jumped way up to 1.2 million in 2019, then 2.8 million, then 3.9 million. The growth is impressive, and if they continue on this pace, they will be a very valuable company in the future. The markets this company operates in are huge. Hair loss is a $3 billion market, erectile dysfunction is $4 billion, anxiety and depression is $14 billion, and dermatology is a whopping $44 billion. The company is headquartered in San Francisco, California, was founded in 2017. It started trading this year and can be found on the New York Stock Exchange and Deutsche Börse. Let's get started with the model. This is a small cap company, 1.8 billion market cap. They're trading at $8.61 a share, and they have 203 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had negative 11 million of free cash flow in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was negative 18 million in 2020. In the trailing 12 months, it's negative 67 million. Revenue is the sales for the company, and that grew from 149 million to 195 million. This is the company's income statement. The top line is the revenue, the sales. They don't have much financial information publicly reported since they just recently IPO'd. So in Yahoo Finance, their numbers are broken down by quarter, but I don't have the third quarter of 2020. That's skipped. This is from one of their presentations. It's a breakdown by quarter from Q4 2019. Their revenue grows pretty much every quarter from 25 million up to 61 million. It was flat from the third quarter to the fourth quarter of 2020. Growing revenue is important, but growing your margins is also very important as well, because if you can convert more of that revenue to profit, it's even better for the investor. And their margins are increasing quite a bit from 61% up to 78%. So they're converting more of that revenue into profit. Their subscriptions go up every single quarter from 190,000 to 453,000. Also, another thing to look at is if a company can grow their average order volume. And they are doing that pretty well, from $43 per order up to $74. Marketing and getting new customers, of course, is important, but just as important is retaining customers and getting them to spend more money by providing good customer service and good products. Below revenue is the cost of revenue, so their cost of revenue is pretty small relative to their revenue because they don't have too much expenses. It's just mainly running their website and of course some people to answer customer questions. Revenue minus cost of revenue gives you your gross profit, and that doubled from the second quarter of 2020 to the second quarter of 2021. And their operating expenses are higher than their gross profit, so they have negative operating income each year. But they're still small in growing their revenue. Once they hit about 100 to 150 million of quarterly revenue, their operating income should start being positive consistently. And they don't have any debt, so they have no interest payments on their debt. and they do have negative net income every single year. There's not too much information in the cash flow section in Yahoo Finance, so I pulled this directly from their financial reporting. The reason I use Yahoo Finance is because it's easier for me to convey information because it's laid out in the same format for every company. Of course, if I need more information, I'll go directly to the 10K or 10Q. This is showing you the last 6 months of 2020 and the last 6 months of 2021. So they do have negative operating cash flow in both of those time periods. And the reason their operating cash flow is a lot better than their net income is because they have $43 million of stock-based compensation. Companies subsidize salaries with stock, and that's a non-cash item for the company, so you have to add it back on the statement of cash flows, even though it's an expense that brings down your net income. In the last 6 months of 2021, they bought $3 million of inventory. So that's a cash outflow of $3 million. But when they sell that inventory to their customers, then it comes off the balance sheet and it's a cash inflow. And of course, they also have to book the revenue and expenses onto the income statement. So their free cash flow is pretty much their operating cash flow. They spent $187 million in investments. These are probably short-term investments like commercial paper or treasury bonds. A company will invest in a really safe short-term security that gets a small interest rate, but they need the cash to be really liquid, so they need that cash available, maybe to acquire another company or just to run its day-to-day operations. They also spent $748,000 from acquiring another company. So that was a cash outflow of $748,000. The company may have cost $5 million, $10 million, and they only used $748,000 of cash, but maybe they gave stock to the company and that was the rest. Or possibly it was a really small company and the entire value was $748,000. This is the equity section of their balance sheet. They have $293 million of equity. They raised $525 million from issuing stock, and they lost $231 million from running their business. Let's look at the capital structure. They have $293 million of equity and they have no debt, so they're 100% equity. It's nice to see a company with no debt, but the main reason they have no debt is because they can't get good terms. They may have to pay a really high interest rate since they're a pretty high credit risk. But when they grow their company and start having cash flow coming in, they're likely to take on debt because debt is a cheap way to finance an acquisition or finance investment back into your company to grow it. And their weighted average cost of capital is 9%, and that's a discount rate we're going to apply to the future cash flows. We estimated 6 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 6. That's $1.2 billion. We discounted those numbers back to today using the weighted average cost of capital. And we get a value of the company of $1 billion. We divide that by 203 million shares. And we get a calculated stock price of $5.14. They're trading at $8.61, so they're trading at a 68% premium. It's a sell according to the model. According to Simply Wall Street, the average analyst projects their revenue to grow 25.8%. The way I grew their future revenue, I grew at 25.8% each year until 2026. And the way I calculated their future free cash flow is I converted 10% of their revenue to free cash flow. The average company converts 10% of their revenue to free cash flow. And I assumed they would have negative free cash flow in 2022 and 2021 and have their first positive in 2023. So it's almost impossible to value a company with such little information. There's a lot of guesswork involved. I don't know how big the market will be, what percent of the market this company will have, also the competition that's going to rise. If you think they're going to grow their revenue more than 25.8%, say 40%, we can just change this number to 40. And now we get a valuation of $1.9 billion. So like I said, it's just a guess. And I'm not saying the company is overvalued. I'm not saying don't buy the stock because there's such little information to work with. And the stock price is not based off of the company's future free cash flows. It's based off of what people think it's worth. In the long term, it is based off of how much the company generates. In the short term, it's just based off of market sentiment. 2 analysts priced this stock and the average price target was $11. This is where the stock has been trading since it was a SPAC. So anytime you see a flat line for several months, it's usually a SPAC. If you were looking at a company with financials way back to 1990, then it cannot be a SPAC because a SPAC has to acquire a company within 2 years. If it doesn't, it has to return all the money back to its investors. Let's look at the 1-year chart. It's easy to see all the details. When the SPAC announced that it was thinking of acquiring this company, that's when people started buying the stock. Before the acquisition was fully executed, they start buying. And then the stock ran up to about $16. And generally when a stock runs up pretty quickly, there is a sell-off. There are a lot of people who think the stock will continue going up, but yet they sell it because they see a 50% return and they don't want to risk it going down. So a lot of people sell off and just take in their money, and then the stock price comes down. And then it got driven way up to about $25, $26 a share. A short seller may talk really positively about the company because they know the stock price will go up initially. So they want it to go way up, but they're not going to buy any stock. They're going to let others buy the stock. Then the short sellers start talking negatively about the stock. A thing people were mentioning is the company is not transparent. They're not providing all their financial information. And then people start questioning the firm, and then the stock goes down 70%. And the short sellers keep buying as the stock goes up, and then they take in all those profits. A company doesn't have to provide financial information from the past. They just have to provide it in the future. It's up to them if they want to provide that information. It will encourage people to buy the stock if a company supplies lots of information, because people feel more comfortable. But if they don't provide information, people may think the company's hiding something. But that's not always the case, because the more information you provide, the more time it takes to put together that information, and then you get all these questions on that information. So then you have to hire employees to answer those questions. And then sometimes information may be incorrect, or they thought it was correct at the time, but there was a mistake somewhere, so they may have to revise something. So it's just easier not to provide anything. Unless you're a public company, then you have to provide certain things. Like you have to provide an income statement, statement of cash flows, statement of owner's equity, balance sheet, whatever the GAAP rules are, generally accepted accounting principles. The company is improving each quarter, but the stock price keeps coming down. Maybe the stock price should have never been this high. Maybe it should have been around $15 a share. The reason it came down lower is because when there's a sell-off, then everybody panics and starts selling the stock because they think it's going to go to zero. But the stock price has nothing to do with the fundamentals of the company. The number of people that buy their products or use their services, they don't care about the stock price. They don't look at the stock price before they buy drugs from this company. If the stock price declines, one negative is if the company needs to raise capital and it wants to issue stock, it can at these lower levels, but it's going to have to issue more stock. Like for instance, if they needed to raise $8.6 million, they would just sell 1 million shares of stock. But if they needed to raise $8.6 million of stock back in February, they would only need to sell about 300,000 shares, not 1 million. So it just dilutes the shareholders more when the stock price is lower. But if you're bullish on this stock, it is a great time to buy because it's come down so much. But it may come down further to $4 or $5. We don't know when the bottom is. But it won't go to zero unless the company goes bankrupt. But right now, they're doing fine and they're growing. The stock is down the past 52 weeks while the S&P 500 is up. The stock fell below $7 a share. The high was 25. And the stock is trading between its 50-day and 200-day moving average. 2.5 million shares are traded each day on this stock. Of the 200 million shares outstanding, 111 million are on float. Institutions seem to like this stock. They own over half the shares, and 5.25% of the stock is shorted. It was over 10% at one point a few months back. Analysts are bullish on this stock, projecting their earnings and revenue to grow more than its industry and the market. If you invested $10,000 into this company when it first started trading as a SPAC, you would have been at over $20,000 at one point, but currently you'd be at $8,800, a 12% loss. The CEO of the company owns about 10% of the stock. There's a venture fund that owns over 9%, Thrive Capital, then New View Capital, then Jack Abraham's Atomic Fund owns 6.5% of the stock. Let's look at their financial ratios, negative net income, so we can't look at the PE. Their price of sales is a little high, but it's gotten a lot better. It used to be like 30 a few months back. Now that the stock price is coming down, it's getting even better. Plus their revenue is going up. And their price to book is pretty good since they have a lot of cash on their balance sheet from the IPO. And they have $2.7 million of goodwill on their balance sheet. The way you get goodwill on your balance sheet is when you acquire a company for more than its net assets. So the premium you paid above what the company's worth goes into your balance sheet as goodwill. And goodwill is an intangible asset. It's really not worth anything. You can't sell goodwill into the market. Since they did their IPO recently, they have a really good current ratio and quick ratio. They have over $300 million of cash on their balance sheet. so they're well funded to grow their business or acquire another company. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 6 companies in the same industry as HIMS, and I'm using the industry code according to Yahoo Finance, and I know these companies are very different, but that's how I compare companies. If they have a number in red, they're worse than the average in the industry. If they have a number in blue, they're better than the average. So they're worse in PE and price to sales. They do have a good price to book since they raised a lot of cash. They have a high current ratio, negative earnings, so they have negative ROE. They have no debt, and their market cap is $1.8 billion, which is lower than most companies on this list. So to summarize, I have them trading at a 68% premium, but I think this company has a great future because what they sell will always be needed. Technology can't take it away. There's always going to be people that need hair loss medicine, anxiety medicine, and all the stuff they sell. The problem is, are they the company to fulfill that need? Will they continue growing and scaling their business and make it really profitable for an investor? That's really the hard part to figure out. They are doing really well since they've been around only since 2017, so they don't have much time in this industry, and they already have almost $200 million of revenue in the trailing 12 months. I know it's not a ton of revenue. That's a decent amount of revenue for only being around for 4 years, and they do it organically. They don't acquire that many companies. So I'm really excited to see what the future holds for this company. I rank their free cash flows 1 out of 10, their revenue 3 out of 10, and their ratio is 1 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.